On June 23rd, the UK will hold a referendum to vote on whether it will exit the European Union, an event that has become commonly known as Brexit, or Britain's exit. The central question, not a simple one, is whether Britain would be better off by itself or as a member of the EU. Multiple developments have led to this, and the stay versus leave argument revolves around a few central issues: immigration, the cost versus benefit of belonging to the EU, and the potential implications for Britain's trade operations. Concerns over increased immigration and its effects, many of them familiar here in the US, have become more pronounced recently, especially as Europe confronted waves of Syrian immigrants and faced the conflicts and tensions the situation inevitably gave rise to. The percentage of immigrants coming into the UK from the EU increased to 42% in 2015 from 29% in 2010. These numbers, along with the fact that migrants put pressure on a country's social and economic systems, are mainly an argument used by the vote leave proponents, who point out that by leaving the EU, Britain will be able to set more stringent controls and more effectively manage the flow of immigrants. Another point of contention is the money that the UK, as an EU member, has to pay into the EU budget every year. The figure that the vote leave camp is quick to point out is Britain's on-paper contribution in 2014, £19.1 billion. Critics argue this money could have been put to much better use internally. What they fail to point out, however, is that EU members contribute to the EU budget, but they also receive benefits in return. The UK is the beneficiary of a previously negotiated rebate agreement, which in 2014 amounted to £4.4 billion. And the UK also received public sector payments from the EU through the European Regional Development Fund and the European Agricultural Guarantee Fund, payments totaling £4.8 billion. Given these figures, the UK Office for National Statistics reports that the UK government's net contribution to the EU, that is the difference between the money it paid to the EU and the money it received, was £9.9 billion in 2014. Quite a difference from the much mediatized $19.1 billion. And finally, there is trade. A sizable 57% of Britain's exports go to EU countries, notably Germany and France. Right now, these markets are easy to access because the trading practices, regulations, and standards are uniform throughout the EU. If Britain leaves the EU, things might become considerably more difficult. The EU might decide to impose tariffs or trade restrictions that would hurt Britain's exports, or even sanctions to discourage other countries from leaving the Union. So overall, would Britain be better off alone or as an EU member? By leaving the Union, Britain wouldn't have to conform to the Union's regulations and would enjoy more political and economic independence. On the other hand, Britain would also lose some of its international political clout as a standalone entity, compared with the power it enjoyed as a major player in an international regulatory body whose decisions it could influence better from within than from without. A Brexit could result in a weaker Britain and a weaker EU, at least in the short term, and could cause instability and volatility that would take a while to resolve. As far as implications for US investors, weaker or unstable European economies could mean stock market declines that would hurt returns. And asset flows trends showed us that US investors increased allocations to European stocks last year. Potential damage could be exacerbated if the pound and the euro depreciate, diminishing the returns of overseas investments even further. This doesn't mean that investors should drop their European holdings altogether, but rather that a portfolio allocation checkup is in order to make sure international holdings are well adapted to each investor's risk tolerance and time horizon.